Before Clarence Saunders, buying groceries meant handing a written list to a clerk who retrieved your items from shelves you were not permitted to touch. On September 6, 1916, Saunders opened the first Piggly Wiggly at 79 Jefferson Avenue in Memphis, Tennessee, and changed that arrangement entirely. Customers walked through turnstiles, picked their own goods from open shelves, carried them to a checkout counter at the exit, and paid on the way out. Saunders patented this self-service model, and the concept spread quickly. According to the company's documented history, by the early 1920s, Piggly Wiggly had grown to hundreds of franchise locations across the country, making it one of the first recognizably national grocery chains in American retail history. To finance that expansion, Saunders arranged for Piggly Wiggly Stores, Inc. to be listed on the New York Stock Exchange in the years around 1919 to 1920. The listing provided access to capital, but brought the company into a world Saunders understood less well than grocery shelving. Stock in a grocery chain was not the usual domain of sophisticated exchange traders, but Piggly Wiggly's growth and public name recognition made it a visible target. Any piece of bad news involving the Piggly Wiggly name, wherever it came from, could now move the stock price. In late 1922, a cluster of Piggly Wiggly franchise stores in the New York area failed. These were independently owned stores operating under license. Their troubles were legally separate from the parent company Saunders controlled in Memphis. But the distinction was easy to blur in the financial press, and a group of Wall Street traders began selling Piggly Wiggly shares short, betting the stock would keep falling. Short selling works by borrowing shares and selling them, then buying them back at a lower price to return to the lender, pocketing the difference. The risk is that the price rises instead of falls. The short sellers targeting Piggly Wiggly were betting that bad news from the franchise failures would drag the parent company stock down with it. Rather than accept the attack, Saunders hired brokers to buy Piggly Wiggly shares quietly and continuously over several months. He financed the purchases partly through bank loans and partly by selling bonds directly to the public across the South, marketing them to ordinary people who believed in the Piggly Wiggly name. His objective was a classic market corner. If he could accumulate enough of the tradable shares, the short sellers would have no place to acquire stock to close their borrowed positions, and Saunders could set whatever delivery price he chose. The whole strategy depended on secrecy and speed, because early discovery would allow the shorts to cover before he completed the squeeze. In March 1923, Saunders publicly announced that he had cornered Piggly Wiggly stock. According to accounts documented in financial histories of the period, he had accumulated enough shares to control the effective float available for trading on the exchange. He issued formal demands for delivery to the short sellers, meaning they were now required to produce the borrowed shares they had sold. Reports in the financial press at the time described the stock price climbing sharply as news of the corner circulated. Saunders, operating from Memphis, believed he had beaten Wall Street's professionals at their own game. The New York Stock Exchange's governing committee moved within days. It suspended trading in Piggly Wiggly shares, which by itself would have been a setback for Saunders. But the committee also extended the deadline by which the short sellers were required to deliver their borrowed stock. That second decision was the fatal one. A corner's entire leverage depends on the shorts facing an immediate, inescapable deadline. Give them more time and they can search for shares elsewhere, persuade other holders to lend, or wait for prices to fall. The exchange justified the intervention on the grounds that the corner threatened orderly market conditions, a rationale within the exchange's own rules. Whether those rules were applied even-handedly, or primarily to protect the Wall Street firms that were short the stock, remained a contested question in the financial press at the time and in later historical accounts. During the trading suspension, Saunders could not sell the enormous quantity of shares he had accumulated at the inflated prices a successful corner would have commanded. He was carrying substantial bank debt, borrowed to finance the months-long buy-up, and the interest continued accumulating. When trading eventually resumed, the conditions that had given him leverage no longer existed. The short sellers had used the extension the exchange granted to locate shares from other sources and reduce their exposure. Saunders now held a position he could not sustain: heavy debt, a stock price well below the corner peak, and no mechanism to force the delivery terms he had originally set. By 1924, according to records documented in Memphis historical sources and business histories of the era, Clarence Saunders was declared bankrupt. His creditors took control of the Piggly Wiggly name, trademark, and operating company. The brand he had built from a single store on Jefferson Avenue now belonged to others. Saunders also forfeited the large Memphis estate where he had been constructing an elaborate personal residence. He had named it the Pink Palace for the distinctive pink stone used in its construction. The mansion was never completed during his ownership. The city of Memphis eventually acquired the property, and it became the Pink Palace Museum, which operates there to this day as a natural history and cultural institution. The Piggly Wiggly episode became a reference point in ongoing discussions within the exchange and, later, in Congress, about the rules governing short selling, market corners, and exchange authority to override active trade obligations. Historians of securities regulation note that the exchange tightened internal procedures around corners in the years following 1923, though the precise rule texts and their exact dates of adoption require careful archival study to pin down. What is documented is that the episode appeared repeatedly in the congressional hearings of the early 1930s, including the Pecora investigation, as an illustration of how the exchange's private governance could be used to resolve crises in ways that did not necessarily favor every market participant equally. Those discussions contributed to the environment in which Congress passed the Securities Exchange Act of 1934, which established federal oversight of securities trading and exchange practices for the first time. Saunders did not withdraw from business after bankruptcy. He built a second retail grocery venture he called Sole Owner Stores, emphasizing in the name that no outside investors or Wall Street interests controlled the company. The stores did not grow to significant scale. He also designed an automated grocery concept he called the Keydoozle, which would use coded tokens and mechanical sorting to fill customer orders without traditional clerks. It was a genuinely forward-looking idea, but the technology available in the 1930s and 1940s could not make it reliable. Saunders died in 1953, having spent his later life in Memphis without recovering the wealth or the company he had lost. The Piggly Wiggly corner is not simply a historical episode. The core structure, a heavily shorted stock, a concerted effort to control the tradable float, and a sudden question about whether the institution governing settlement would change the rules mid-trade, has recurred in various forms across the century since 1923. It attracted wide public attention again in early 2021, when retail investors coordinating through online forums drove sharp price increases in several heavily shorted companies, and some brokerage platforms briefly restricted purchases of those stocks. The accusations that followed were structurally similar to the accusations Saunders made in 1923, that rules had been altered to protect the parties holding short positions. The 1923 episode did not establish a permanent principle about how such conflicts are resolved. It established, rather, that private exchanges and brokerages have historically claimed authority to intervene in active trades when they determine orderly markets are threatened, and that determination can be contested. The Piggly Wiggly story is ultimately about market structure, meaning the rules, institutions, and authority relationships that determine how trades actually settle when conditions become extreme. Stock markets are not neutral mechanisms. They are operated by private institutions, exchanges, and brokerages with their own rulebooks, governance bodies, and interests. Understanding short selling, margin, and settlement mechanics matters because those mechanics determine what happens at the edges when a position becomes a corner, when a squeeze develops, when a firm faces delivery obligations it cannot meet. When you hear about a short squeeze today, the question worth asking alongside who is winning is who sets the settlement rules and what authority they have to change those rules while the trade is still open. The Piggly Wiggly corner shows that the answer to that question is never fixed permanently. It gets renegotiated case by case by the institutions that control the plumbing.